This podcast is intended for investment professionals only. All investing involves risk.
Hello and welcome to LNG Talks. Our topic today, dividends. What role do they play in total investment returns? Where are the opportunities and what are the risks we need to avoid? My guest at this time, Elisa Piscopiello, Senior Index and ETF Analyst at LNG, will help guide us on this journey. Elisa, welcome.
Hi, Luka. Great to be here today.
And you're so excited you took a flight just to get here, didn't you?
Absolutely, yes. I'm glad I made it on time.
Great. Right. Let's start with the basics. Why might investors look towards a dividend income strategy today?
Two of the strongest arguments are regular income and financial discipline. So let's start from regular income. Prices can go up and down, but dividends typically are less variable. So we're recording this on the 21st of January, and we're seeing this week, following a lot of announcements, a lot of volatility in the markets. So stock prices across the world are moving down predominantly. Markets are quite volatile, but dividends, companies are not stopping to pay dividends. This is a great example to illustrate how dividends act as natural buffers at times of choppy markets. They can provide, companies that pay dividends are providing that constant stream of cash flow to investors. But it's not just about the payout. We've spoken about regular income. Another strong argument is financial discipline. To be able to consistently return that capital, those dividends to investors, shareholders, to pay those dividends every quarter, year after year, a company needs to be financially healthy. It needs to have a strong business model. It needs to have invested in growth already. It needs to have a strong outlook to be able to deliver on this promise of dividend payout and growth to investors.
So, for example, not to plug ourselves too much, but that's something that LNG Group is doing, for example, right?
Yeah, absolutely. So as a company, as a group, LNG is an example of having the objective to return more capital to shareholders. And this is a part of a long-term disciplined capital return framework as a company. And this is just an example that has met financial targets, has invested in growth, has a positive outlook, and can really deliver on this regular payment, the regular dividend.
Okay, so you've pitched your case for dividend investing. Who would you say the target market is for dividend investing? Is it historically has been viewed as a thing for pensioners, right? Looking to plan their retirement. But is that the only case, or are other people up for investing in dividends?
Anybody can consider dividends. As you say, historically, having this idea of retiring on income, dividends are a bit like coupons for bonds. Dividends are for companies, but you can actually invest in really exciting companies that pay dividends. As I said, there is a case for as a quality screen, so screening for quality, that financial health. If a company is paying a dividend, it is likely because it is healthy from a financial point of view. So it acts as a screen. And then for investors today, not just who is planning to retire, dividends can really act as that income diversifier. Markets today are really concentrated. We've been speaking of years about concentration in stock markets and price volatility. And just to give you a number, dividends since the start of the century have been 3 times less volatile than earnings.
3 times?
So it's really a way to diversify that income. You have the beta with price movements, but you also can have that constant cash flow.
Okay. So you mentioned it being obviously as a key buffer against volatility in that sense, or it can be viewed as one. Targeting sustainable dividends seems like a smart move. Then how do you look for companies that do that? And is there a segment of the market where it's most relevant?
I think this is looking at dividend strategies today can be particularly powerful in emerging markets because that is a market where we see more dispersion in quality of companies.
Okay, emerging markets. You wouldn't really associate emerging markets historically with dividend strategies.
Exactly, because they have a lot of high growth new companies coming to the market, but we need to make a distinction. So in EM, like in all markets pretty much, we can find incredibly strong, well-run companies with strong balance sheets and strong profitability. But also companies where the balance sheets may be weaker, less transparent, or shareholder alignment can be a bit more questionable. And this gap, this dispersion, can be particularly high in emerging markets. And this is why looking into dividend strategies, so having a framework that focuses on dividend-paying companies, can help investors cut through that noise, because you can look for high income, high dividend, but through this, you can also find companies with stronger fundamentals and better governance practices.
This seems particularly important in the current climate where we're seeing a shift for investors moving away from the US into other markets, and particularly emerging markets, right?
Yeah, absolutely. We are seeing that today the US has returned incredibly well, especially up to 2024, but now we're seeing that shift towards other markets like even Europe, but also emerging markets. And there are opportunities in EM. So we've spoken about dividends as a signal of financially healthy companies, high quality companies. There are opportunities here with exciting companies like Delta Electronics, as an example, just to mention one from Taiwan, it's an emerging market. It is a company that is developing energy efficiency solutions, advanced automation systems. So you can find innovation even in these markets.
Okay, that's interesting. Sorry to interrupt you there, but it's interesting because I suppose dividends historically have been associated with boring companies and possibly companies that don't meet the ESG criteria of modern investing. So tobacco, oil and gas, and so on, and pharmaceuticals as well, although they can be ESG focused. But are those really the only sectors, or as you mentioned, there are some more interesting sectors that offer dividends?
Yeah, you can find dividends across all sectors. And it's actually important to look across all market caps as well, all countries. As you said, there are opportunities in the US, for example. So typically on a regional level, we've seen most opportunities with dividends in countries like Japan and the United Kingdom, where we see a lot of industrial companies or financial or energy companies. But you mentioned pharmaceuticals. If we go to the US, for example, Eli Lilly is a strong dividend payer. So you can really find them in all countries and regions.
So this seems particularly relevant for investors today as we're seeing a move away from the US into other markets, particularly EM, right?
Absolutely. This is what we're seeing this year with investors trying to diversify from a currency perspective and on an equity exposure perspective. So moving from the US to other markets such as EM. And looking at dividends is a way to do that because, as I said, it gives that signal to find financial health. So it's not just the price return, that cash income component, but investors can look at dividends as a risk management tool. Of course, as long as they don't fall into dividend traps.
So could you explain what a dividend trap is? I mean, can companies pay too big of a dividend?
Yeah, absolutely. And that is exactly a trap. When we look for dividend-paying companies, essentially we are looking for high income, so a high dividend yield. And if you do the math, the dividend yield is simply dividend over price. And if price, that denominator, gets lower, we may incur in a dividend trap. So the dividend yield, so dividend relative to price, can look exciting, but for the wrong reasons. So imagine a company whose price has fallen because of fundamental reasons. For example, the balance sheet has deteriorated or earnings have weakened over time. We would have a high dividend yield for the wrong reasons. Or there can be another situation where a company, in order to be able to keep paying that constant regular dividend, is not investing enough in innovation, in growth. And therefore, this can erode competitiveness for the company within the peer group, and then it can create a real performance drag in the long term. Dividend traps are real, and in fact, the dividend yield on its own tells us pretty much nothing on the sustainability behind that number. We need to really look further, and we need to understand whether, after looking at an attractive dividend yield, a company looks attractive or looks and is fundamentally appealing.
So a high dividend yield can either mean a company is doing really well or it's doing really badly.
Yeah, exactly. And we do need to avoid it, right? First, we look at the data that we have. So we can start looking at past dividend payments and past dividend growth. Definitely, this is a good way to start. But then other ways to try to avoid these dividend traps can be looking at the future. So trying to look at expectations. What are markets expecting about future payouts for a company? Are they positive? Are they promising? And then we really need to do our analysis further on the financials side. So we need to really look at the balance sheet, the income statement for a company in the context of its sector, of its peer group, to understand whether we may be falling into a trap or whether that company can sustain that dividend. For example, if we look at the balance sheet, we can look at asset growth, and we can check if the company has grown assets in a sustainable way, or if that growth rate of its assets is kind of too good to be true, so that it's unsustainable. Or we can look at debt as well. That is not bad as such, but we need to understand whether for a company it is sustainable, whether it can pay it, basically. And then we can look at revenues as well, and we can see if a company looks profitable just because it's recognizing revenues too soon, or whether it's recognizing revenues when it is getting paid, and so everything is transparent and sustainable. So it's really important, in order to try to avoid a dividend trap, to build a framework that doesn't just look at dividend yield, but is more comprehensive and looks at other numbers. Really, it's important to do the work, basically, and analyze the company.
Okay. So we've talked about looking at the company individuals. Let's talk about portfolio building, right? So in a rules-based strategy, weights play an important role. Does that help avoid a dividend trap as well?
Yeah, it's another way for sure, and something to add to this framework when we do our analysis. On the market, what I see, just to simplify, there are 3 ways in which you could weight stocks. So there's a market cap weighting, a dividend yield weighting, and an equal weighting. And then they can all be adjusted, but broadly, we're speaking about these 3 ways. In a market cap weighting, we could incur into concentration. So an investor who is investing in a market cap weighted index may be actually investing a lot of the weight into stocks that have already won. So those that have already performed really well, so the price has gone up and look more expensive, become more expensive too from a valuation perspective. So definitely these can have an issue from a concentration point of view. Then moving on to the second weighting scheme, of course, in an income strategy, it can be very intuitive to weight companies after we've identified them based on their dividend yield. So to assign more weight to those that have paid higher dividends. But this is exactly where a trap may hide, the dividend trap. And it can cause issues from a concentration perspective as well, because as an investor, we may end up holding a lot of our assets, a lot of the weight, into a handful of stocks. And then if something bad happens to those companies, if some of them are a dividend trap, then we have fallen into that trap. And a way actually to weight companies that promotes diversification and mitigates this risk of falling into a trap is to follow a weighting approach that equally weights all companies. So every company, then you can make adjustments for liquidity and other adjustments. But broadly speaking, you assign the same weight to every company. And of course, here you can be more diversified because you're not betting on just a handful of stocks, but your weight is better distributed. And so, something may happen to one stock that pays high dividend. Maybe they suspend it, but hey, you have a portfolio with so many other stocks with such a nice and balanced distribution that you're not impacted as much. So you need to really find from a weighting scheme aspect, you need to calibrate these three factors, I would say. You need to look out for traps while still finding income, and you need to try to mitigate concentration if you want a well-diversified portfolio.
So we've talked about the risks. Let's talk about the opportunities as well. One of the questions I mentioned in the intro was which countries might appear most attractive for dividend investors. What would you say there?
There are countries like Japan and the UK, for example, where we see a lot of companies paying high and sustainable dividends. And this is down to the characteristics of these countries. We see a lot of companies in Japan, for example, working in the industrial sector, or in the UK, companies related to financials or energy. But even in emerging markets, we can find opportunities for high dividends and exciting companies.
So you're saying it's less about the country and it's more about the framework you built to find the opportunities?
Oh, yeah, absolutely. And actually, I find that having that framework to avoid dividend traps while still looking at high dividend yielding companies can allow investors to have a sort of menu with regional choices and express their regional views for asset allocation in a tactical way.
So you're obviously very a big proponent of dividend investing, but one of the arguments that people make these days is that markets have been so strong recently. Everything seems to be going up. Mentioned at the top that markets have taken a little dip recently, but still they're near record highs. How do you find value and dividends in this kind of market environment?
I think the weighting aspect is very important there to avoid that concentration in the winners and very expensive stocks. I agree with you in the sense that today it's quite tough to find sectors that are fairly valued or cheap compared to their history. Everything seems to be expensive at the moment. So looking at the weighting aspect and looking across all market caps can be a way to be more diversified and avoid that concentration in those winner stocks that have already appreciated with high PEs. So overall, it's possible to even find income, so focus on income without compromising on valuations.
Okay. Well, thank you very much, Elisa. It's been very informative. It's been a whirlwind tour through the world of dividend investing. Do you want to give us a quick recap of the topics we've discussed today?
Yeah, absolutely. So we started by speaking about why we can consider dividend today. So I've spoken about the regular income aspect, but also the signal of financial discipline for the companies. And then we've explored who can consider dividend strategies, so a wide range of investors. And we've spoken about dividend traps as well, something definitely to look out for when we invest in this strategy and how to avoid those. And then we looked at various regions and sectors where we may find high dividend paying stocks. And at the end, we've also spoken about ETFs for exposure to dividend strategies, and we've concluded with valuations too.
Thank you, Elisa. That was a very succinct summary. Thank you very much for your time, and thank you for joining us today. We hope you found an informative session, and we look forward to welcoming you next time on LNG Talks. Bye-bye for now.
As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. The views expressed in this podcast are those of L&G's Asset Management Division, as at the date of publication. This podcast is for informational purposes only, and we're not soliciting any action based on it. The information discusses general market, economic, or political issues, or industry or sector trends. It does not constitute research or investment, legal, or tax advice. It is not recommendation or advertisement to buy or sell securities or pursue a particular investment strategy. Assumptions, opinions, and estimates are provided for illustrative purposes only. There is no guarantee that any forecast made will come to pass. No party shall have any right of action against L&G in relation to the accuracy or completeness of the information contained in this podcast. Where this podcast contains third-party information, the accuracy or completeness of such information cannot be guaranteed, and we accept no responsibility or liability in respect of such information, not for distribution to any person in any jurisdiction where such distribution would be contrary to local law or regulations. Copyright 2025. Legal and General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. Unless otherwise stated, references herein to L&G, we and us are meant to capture a global conglomerate that includes, in the European Economic Area, LGIM Managers Europe Limited, authorised and regulated by the Central Bank of Ireland as a UCITS management company pursuant to European Communities Undertaking for Collective Investment in Transferable Securities Regulations 2011 as amended, and as an alternative investment fund manager pursuant to the European Union Alternative Investment Fund Managers Regulations 2013 as amended. In the USA, Legal and General Investment Management America, Inc., a US SEC regulated investment advisor. In Japan, Legal and General Investment Management Japan, KK, a Japan FSA registered investment management company. In Hong Kong, issued by Legal and General Investment Management Asia Limited, which is licensed by the Securities and Futures Commission. And in Singapore, issued by LGIM Singapore Pte Limited, company registration number 2022318776W, which is regulated by the Monetary Authority of Singapore. For full terms and conditions, please visit our website. To find more content, you can check us out on LinkedIn or on our website.